So BHP did put out their full year FY16 result after the market yesterday. Very pleasing to look across the numbers. It did beat consensus in terms of EBITDA and underlying profit, which is always a positive. In terms of where it came against our estimates, revenue was roughly in line. EBITDA was also in line, but was, as I said, 4% ahead of consensus, while underlying profit was significantly above our estimate by roughly 400 million, as well as ahead of consensus. So looking through the result, it really comes down to the fact that EBITDA margin at bottom of the cycle is still averaging about 40%. That compares to Rio on 33%. Rio, of course, is being dragged on by things like its Alcan assets and coal, whereas BHP, obviously, even though oil has had a pretty rough ride, still a reasonable EBITDA margin performance for bottom of the cycle. So, really looking forward now. FY17 is going to be the banner year for the company coming out of what was quite a terrible FY16. As I've mentioned in previous presentations, the fact that FY16, not only did we have commodity prices cratering in the first half, but we also had production losses across most of their key divisions for all different reasons. That really did set up quite a negative setting for FY16 that came through yesterday. So FY17, though, we've got production recovering across several key divisions. At the same time, we're already seeing high commodity prices, as we've been hoping would come through. And really, if you put through, which the company touched on yesterday, and it's been one of our key buy thesis for the last 6 months, if you put through spot commodity prices into our model or even just BHP's own model, free cash flow would be more than or almost double what it was in FY16 in FY17. So it's that kind of earnings leverage that really all we need is for the current stabilisation of commodity prices to continue. To really unlock really material earnings and cash flow gains from here. So it's not a question of will FY17 be higher in terms of earnings and cash flow. It's a question of how much. So, if you're not as bullish as us, we're certainly above consensus in 17 and 18. The reason for that is our more bullish view on oil, obviously, and as well as copper. If you don't share that optimism, I still would point to the leverage and the fact that even the most negative pundits in the market still have earnings growth coming through. So the fact that we've now been pulled into an upgrade cycle, the first time in several years since 2011 for BHP and the sector, I think it's going to be a pretty powerful tailwind. So really going into the first half of FY17, in addition to just recovering production across several divisions, also just looking for further kickers in oil. Really, with the oil market now moving back to balance or in balance supply, to me, it's still the same story that I was pushing earlier in the year. I don't know what the supply disruption will be, but there is always a supply interruption in the global chain. But now the market, given its imbalance, is much more susceptible to that kind of talk, and the market will then find reasons to ratchet up the oil price. So, as I said, we are above consensus, but very happy with where we're sitting. I am in the process of updating the model. Unfortunately, it takes a bit of time, and then we'll put out an update sometime today. But you're more than happy. We've got the same view. Still have a buy recommendation. Our last price target was around $26, which I'll update with the model today.